The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
By actually having these policies structured inside super, you automatically receive a 15% discount on the premiums. So you're already saving money just putting it within super. And then also as well, we can structure it and you can structure it in a tax effective way that these premiums that you're actually paying for these insurances, you're actually claiming a tax deduction on it.
Welcome to the Wealth Guide podcast brought to you by the team at Ryker Capital. It's that time of year again. It's tax time. So what we want to talk about today is the top 8 tips that the team at Ryker Capital can provide to you watching this or listening to this podcast of how you can structure your situation better and pay less tax. Because let's face it, we all want to make the most of our resources, and we've all got a lot more to do with our money than pay it to the tax man. Now, we're not accountants, so all we're doing is generally talking about topics that relate back to taxes and things that you can do to reduce the amount of tax you're paying. So please just listen, relax. If you want to know any more about any of the topics, you can go and speak with your accountant or your financial advisor about those. I'm going to introduce my advisors again. Can I just go around the grounds and start with you?
Hello, Ricky Regmi, Financial Advisor at Ryker Capital.
G'day guys, Ray Regmi, Senior Financial Advisor of Ryker Capital.
Hey everyone, Dean Dasuki, Senior Financial Planner at Ryker Capital as well.
Awesome, and I'm Jasmine Logue. I'm the General Manager at Ryker and I'm also a Qualified Financial Planner. Look, the first top tip that I wanted to talk about today is the concept of salary sacrifice. Ricky, take it away.
That's a very important topic. Salary sacrifice, as the name suggests, you are putting away a little bit of your salary into super for future, for retirement. It's a good strategy where it allows you to not only grow your retirement capital, but also claim it on a tax deduction. So it's a really good scheme where government allows you to boost your retirement whilst also minimising the tax that we pay. There are limits on how much can be put in, and government has introduced cap limits. So there is a limit of $27,500 at the moment, which includes employer contribution.
Right.
So we need to be very careful of that.
Okay.
So just to keep a simple math, because I'm a simple math guy, so $27,500 is the limit. So for example, your employer has put in $10,000, which leaves us $17,500 to put into super. Now, it all depends on client situation. It all depends on what we have going. We all have mortgages to pay. We all have expenses to pay. However, it is a really good strategy to boost retirement capital because we do need to focus on it. We should be looking at that. It is also important to look at, you don't have to go all 27.5, so you can do a little bit less. However, it is a good tool to have and for your tax saving.
Okay, so let's say I do have a solid income. I might earn around that 100,000. And again, simple maths works putting in 10,000 for me. So why exactly am I saving tax rate if I decide to put, say, I don't know, another $10,000 in of my own money?
Absolutely, Jazz. I think, look, going back to the basics of it. So what it is before your salary is even paid to yourself and tax being taken out. So the concept of salary sacrifice is that money is taken aside from your pay before you even taxed on it, right? So when you take away that $10,000 and you were earning $100,000, now you're left with $90,000 to be taxed on. So that's the beauty of it, is because you're letting go of that pre-tax. Now what it helps you reduce is your taxable income and helps you grow your retirement savings.
At the same time.
Now, there are different forms of salary sacrifice. You could, people do that for cars. People do that, especially in the health and medical sector. They're allowed to salary sacrifice for a variety of different things. So they have that advantage of salary sacrificing with potentially meals and loans and variety of other aspects. So there are various forms of salary sacrificing, but the gist of it is you're letting go of that pre-tax.
Okay, so say, Dean, if I had put in $10,000 and I now get taxed on $90,000, do I get the $10,000 tax-free?
No, so what actually happens is that 10,000 that goes directly within superannuation, what will happen is as it goes in, it'll get taxed at the super tax rate being 15%. So instead of you paying that 37 cents in the dollar, you will only be paying that 15% tax rate when it goes directly within the super fund. So you save a little bit of money on tax onto it as well.
That's huge. So I'm thinking in my head, okay, I've sacrificed 10,000. I would have paid between 3,000 and 4,000 of that in income tax.
Yep.
So I would have been left with, make it 6,500 grand.
Yep.
But if I pop it into super to save for later, I'm only paying $1,500 in tax.
Correct.
So a full 8.5 goes into my super fund.
Spot on.
Exactly.
That's pretty good.
Now,
Also-
Jazz, the magic of that, compound that over the next 20 years.
Exactly.
When you say that, what do you mean exactly? I've heard this said a lot. Compounding, interest. Tell me more.
Compounding is a simple mathematics of money earning interest on interest. So as an example, $10,000 earns 6% interest, which is simply 10,600. Now you do that over every course of the year, it builds up. It starts to build up over the course of a period of time. So that's your compounding in a very simple mathematical sense.
Yes, I do know what you mean because it's the exact opposite on my home loan, right? The less I pay off my principal, the more interest I have to pay. So that's really cool.
And there also have been studies on it as well where it has shown if you start investing early, the balance at retirement would be a lot more compared to people who start doing later. So say in their 40s and 50s, the compounding effect is a lot less compared to if they start doing early when they get a full-time job. And even putting a small amount of money away, it just compounds and makes a big difference in 20, 30 years' time.
Actually, that reminds me of a client that I looked after. It was quite funny because they were both living, it's two families, they were both living in the south of Sydney, and it was very similar position. So husband, wife, 2 children, the mother looked after the children for a while, but then she went back to work as well. And one of them saw me when they were about 50 years of age, and they still had 15 years before they were desiring to retire from working fully. So having 15 years to plan, that's a good amount of time. The other couple came at 62 and a half and 63 years of age. And they were also looking to sort of retire in about 5 years timeframe. So it was a really good story for me to show to other clients in the future. If you start planning early, it's just so much easier. Compound interest is really, really good. And the other thing that I think as well we need to think about is the government changes rules a lot in this space. So at the moment, you've got the cap of how much you can put in, and you've got that saving of tax. So at a rate of 15% instead of, say, 30%. We need to take advantage of that now, because we don't know how long they're going to allow us to save in this way. Okay, let's say I'm ready to go, Ricky. I'm sitting there in the morning at my desk thinking, I'm going to salary sacrifice. How do I do that?
Just there's two ways of doing it. One, you can do it through your employer. So you can let your employer know, especially if you're working for mid to a higher level employer, they generally have a HR department where you can speak to them and ask them to contribute, take a portion of your money away. Could be for a variety of different reasons. Salary sacrifice into super is one way. Could be to buy shares, could be to buy other things, even car lease payments. So there's different ways of salary sacrificing. So contacting your employer, the first step. However, when we talk about super, we could potentially also, government's allowed the rule now, the rules have changed where people can personally put money from their bank account and deposit. If we're talking about super, you can actually put that in and then put what we call a notice of intent to the super fund to let them know the money that I'm putting in, I intend to claim it on tax. So there's a separate form that needs to be filled out. That goes to the super fund, which they acknowledge, which means when super fund report to the ATO, because they do after the end of every tax year, then government ATO can match my personal tax return if I wanted to claim 10,000. So super is giving them the same information as what I'm putting on my tax return to ensure it's correct.
That sounds like a really good thing to consider.
But how good, right? I'm like, I put money in my own fund, like I'm paying myself, and I'm telling ATO, I'd like to claim that as a tax deduction. Thank you very much.
Dreams come true.
Right? It's either I give that money away to the ATO or I get some of that back. while I'm paying myself.
And
Brilliant.
we've got that ancillary benefit for in 10, 20, 30 years' time, you're going to see that difference in
Exactly.
consumer.
Whilst enjoying the benefit of compounding at the same time.
That's the main idea. The main idea is the growth of retirement capital, tax savings and everything that comes secondary. The main objective is to have that bigger bucket of gold when we retire.
Amazing. I want to keep along the same line of thought when we start talking about our second top tip. Ray, can you tell us a little bit about this reasonably new concept called catch-up contributions?
All right, Jazz, can't talk enough about this strategy. Absolutely love it. So you know how we were previously talking about salary sacrifice? It's pretty much a continuation of that.
Okay.
The only difference being that you look back 5 years and go, right, what did I contribute? Did I contribute up to the maximum amount? And if I haven't, it just allows me to bring that all together and put that money in super. Now, I've utilized these kind of strategies with my clients so many times for a variety of reasons. Now, that would be to either boost up their super, and as an example, one of my clients sold their investment property. Mm-hmm. Now, they have this massive looming capital gain tax bill, right? Now, imagine this. I've got to pay $80,000, $90,000 of capital gain tax, but my objective is also grow my super fund. I said, what a perfect marriage here. Let's look back what you haven't contributed over that period of time. We brought that together, boost the super fund, but at the same token, claim that as a tax deduction and minimize my capital gain tax. How good?
That actually brings up 2 points that clients are going to love. First of all, when do you get the chance for a do-over when it comes to finances? Not very often.
Not very often.
So if you've missed that opportunity to contribute and save the money, I mean, 5 times $1,500.
Yep.
You're talking large sums of money here.
Absolutely.
So you've got to see when that kind of opportunity presents itself, you've really got to see whether you can take advantage of it.
Spot on.
And then secondly, when you're someone that invests, you know, you're someone that's choosing not to go on a holiday or buy a new car, but you're putting that money into a property, you're really, really committed. And then you get hit with the capital gains tax bill when you sell that. It does hurt a bit.
Oh, absolutely.
So if you can mitigate that,
Yeah.
I really love that.
Right? I'm like, people invest a lot of heart and soul into this investment property where they've made repayments and paid a lot of these expenses over time, whether it be the rates, the water, the real estate agent fees and everything else. But to then be hit with the capital gains tax when they sell the property is a bit of an ouch movement, right? And that ouch, sometimes, how do you negate it? With using some of these strategies like that, the catch-up contributions. So it's a great initiative by the government to allow people to do that, to boost their super fund. Obviously, there are some tricks around it because obviously if you have a balance over $500,000, you cannot do that. So that's the big part that you got to keep that in mind. If you have balances over $500,000, you cannot do the look back.
Look, that's a really good tip. So I think if anyone's in a position to consider that, they should definitely look into it. And if you need some help with it, that's when you go and speak with your financial advisor
You
and get
absolutely
that
do.
support.
Yep. But I think it's key imperative, again, I'll bring back to the point, you want to do your maths around it.
Yes.
Because the moment, if you get it wrong, the impact is quite large. Instead of saving on tax, we are paying more tax.
You have to be.
Yep.
You have to be spot on with this.
Yep.
Look, thanks heaps for that. I want to change tact a little bit and talk about another thing that we can deduct that's really beneficial for us as people. I always like it when I can use money that might have gone to the ATO to directly benefit my family instead. Dean, can you tell us a little bit more about this concept of how personal insurances, so I'm talking about life, total permanent disability, trauma or critical illness cover and income protection, not sort of the other covers like home, car or public liability, but the ones that you can have in super and how they interact with tax. Why does it matter?
Sure. So, look, with these personal insurances, one of the key beautiful things about it is when we structure them correctly, you can actually claim a tax deduction on it. And the benefit behind that is not only does it allow you to actually reap the rewards of having the cover and putting something in place, but then we can get a little bit of money back from the taxman at the end of the year. Why not?
Love it.
Right? So by actually having these policies structured inside super, you automatically receive a 15% discount on the premiums. So you're already saving money just putting it within super. And then also as well, we can structure it and you can structure it in a tax effective way that these premiums that you're actually paying for these insurances, you're actually claiming a tax deduction on it.
And how would that work, Dean, specifically?
Yep. So what would happen is that you would structure these policies inside super, and then you would then make some contributions back into super to pay for these premiums. Instead of you traditionally taking it out and funding it from your bank account and not having much diversification around being able to claim tax deductions on it, you can structure it inside super, and then those premiums that ultimately you would have used to actually pay for the insurances, you can make then those as super contributions, and then you can claim that as a tax deduction.
I get it. So what you're pretty much saying here is, instead of me paying that to the insurance company, I'm now putting that contribution in my super fund.
Correct.
Which then I get to claim that as a tax deduction in the form of notice of intent. And insurance company takes that cover out from my super, for which I get 15% rebate. Would that be right?
Correct. Correct.
It's the same concept as when the first example saved $1,500 in tax.
Yeah.
By putting in
Brilliant.
the $10,000.
So I like the
use part
idea
of that.
because if you think about it, life and TPD cover traditionally is not tax deductible anyway. So now, instead of me having to pay that from my bank account, if my super fund's funding it, but I'm compensating my super for it, because I don't want in my retirement is to have a reduced balance because I've been paying insurances all along from my super fund, I get to claim that as a tax deduction. So in other words, I get 2 bites of the cherry.
Oh, why not? Take it. You can get it.
Wow. Okay. How good.
Ricky, can you tell me a little bit about some of the traps though around this? Because having your insurance directly connected to your super, there's a couple of things you do need to be mindful of.
Exactly. Main thing, or there's a couple of things I'd like to touch on. If we are putting money into super, we need to also think about the cap limits that are available. So we need to ensure that we don't breach it, because, like I said, super funds do report at the end of the year to the ATO and the balance that's been contributed. So that, and there is a cap in place, $27,500 at the moment at this year, which we need to ensure that we don't go over that cap amount when you're thinking about putting money into super. Another thing we also need to think about is having insurance in super. It comes with its own rules, because there are superannuation Act that controls super, which has its own restriction on when things can and can't be paid out. Life cover, for example, is generally most of the time it does get paid out because the member has passed away. So the superannuation benefit and the insurance benefit get passed on to either to the estate or to the beneficiary. With the disability cover, that's another, because it's got its own occupation definition. Without going too much into detail, it's either any occupation, which is what you can have in super, which is sort of loose in a way where it says member can do any occupation based on their training, education or experience. So there could be an argument that, well, an office worker, if they are, for example, wheelchair bound, they still do work. So there are a lot of changes around the definition. So definitions are quite important. And not only insurance definition and also superannuation definition, to make sure that the client does actually get the benefit, what they're paid for, and it doesn't get just preserved in super.
That can be a risk, because we all know that you can't take your super out just because you want to.
Correct.
It's therefore when we are 60, 65 years old and we're ready to retire. But I guess the government does see the benefit of someone having a plan B, having, say, for example, insurance in place. So they're letting us use that along the journey. But you're absolutely right. I have seen instances with clients where the payout happened. So the insurance policy paid out for, say, a disability claim, but then the money was sort of trapped inside the super fund. So I really like this idea of having a policy that you pay for yourself, as opposed to just having the one that was in the super as a default and then claiming the tax deduction on me adding that money to super. So that's a really good concept. I think a lot of you out there wouldn't be aware of that. So take a look and see whether you can save some tax whilst you're using your superannuation to be the home for your insurance.
And this is also just to ensure that we don't erode the super balance with the premium.
That's a very big one.
That's the main objective of it, to ensure, because insurance premium, they are still a cost. They get paid out of super, and people like to have it there so it doesn't affect the cash flow. However, we also need to factor in the fact that we are playing with retirement capital. The whole idea of putting money into super is to ensure we are replacing that and we are not letting our super balance erode, and we get a tax benefit out of it. So that's a great thing to have.
And us as advisors are very mindful of that fact that obviously you cannot, I think the whole concept around retirement is to preserve that money for retirement, and it's not eroded purely by insurances. It shouldn't happen that way. It's a good tax utilisation strategy, but it can't be a mechanism to fund all your insurances and not replacing it.
Correct.
It's a very interesting point of what you're saying there as well, Ray. Like I've personally seen with clients a few times where they've taken out these insurances and they've done some stuff within the super fund, and then they may have stopped contributing back into super, and then unfortunately these premiums did slightly increase. So the big danger here is that if your super contributions are going to start being mainly consumed by your insurance premiums, then you're not going to really see any growth within the super fund. And this is why I always tell my clients, whenever we look at structuring insurances inside super, as a bare minimum, we should look at reviewing them every 3 to 5 years, because whether you've got a change in your circumstances, making sure that these premiums are not really going to be detrimental to your retirement savings.
Excellent point. I want to change tact a little bit now. Let's talk about investment properties. There's one thing that I've noticed not everybody is aware you can actually do to really reap some tax benefits from having an investment property. It's depreciation schedules.
Love it.
Who wants to tell me a little bit more about the tips and traps around the depreciation schedule?
Well, I can start, Jazz. There are, with investment properties, depending on their age, depreciation schedule helps. So age of the property is the key. The newer properties have longer depreciation that can be claimed. So it is very important if you are looking at buying a property and you are thinking about depreciating the property over the life of it, it is critical to understand how much you can claim. And it is important that you speak to a professional before you do that.
Well, Ray, can you tell me what is even meant by depreciation?
Yeah, absolutely, Jazz. So depreciation is pretty much when you buy an asset, you're claiming, so in this purpose, an investment property, you're claiming that door handle, you're claiming the bricks, you're claiming the glass, you're claiming that ceiling. So anything that constitutes that property and inside that property, you're claiming that as a depreciation. So basically what you're creating is what did the value of that asset was, and depending on the method of the depreciation, you are then claiming that over the period of years of that cost.
I get that. So if I buy something and I'm using it for a purpose, like say an investment property, it gets older over time. So I should be able to claim back
of what's left of
that
it.
aging of that asset. That makes sense to me. But it does sound complicated. How can I know how much I can depreciate of my investment property? Do I have to work that out myself?
You usually have a tax valuer, I'm assuming, that will sort of step in and sort of create the schedule for you. I'm sure there are a variety of different organisations that do create those depreciation schedules, and they will give you a good transparent idea of what you can claim, what you can't claim.
It's actually really important though, because depending on who your builder or the construction company uses to create those depreciation schedules, there's actually a difference in the benefit to the end client.
Yeah.
So if you've got a company that's really well versed in that makes the most of all of the depreciation you can add to the schedule, you might actually be thousands of dollars better off.
Correct.
So if you're looking into purchasing a newer property, definitely think about that. The other tip I've got in this space is I had a very young gentleman that bought a property in the north of Sydney. He bought it and it was about 18 months old at the time. It was a bit sad because the person that had sold it wasn't able to keep the property. Their cash flow wasn't quite worked out right. So thankfully, this young gentleman had been a client of mine for a couple of years. We'd worked through their cash flow, did some tax saving along the way, and he was ready to buy a property. But if it hadn't have been for giving him that tip around asking to be given the depreciation schedule, he would not even have known that 18 months in, there was still a good amount of time left of some of these assets still being in the period of time where they continue to depreciate, and you can continue to get your tax offsets around that. So if you're buying a property, if it's younger than 10 years, definitely have a look at that. Ask your real estate agent and see whether that depreciation schedule is available, because you might be able to offset that off your tax.
Yeah,
I think that's a good tip.
Yeah, certainly be talking to the accountant and the surveyors to ensure that, there is a depreciation schedule available, and you look at it to ensure that does give you the timeline that you want to claim on. So that's certainly important.
I think it's a major factor in some of the property purchase decisions that we've sort of seen with the client over the years is what how's it going to align with my tax strategy? I think it's a key component of it.
It can make a major difference to working out whether you can afford to buy the property.
Absolutely.
Because if you can adjust the amount you may need to add to repay the loans or cover the costs, if you know you're going to get a solid tax deduction for that, you can take that into account when you're doing your numbers.
Yeah. And effectively, when you get the larger component of money back from the form of tax return, it helps you put that back in the mortgage, really. But
yes, you can be forced savings too.
Yeah.
Great. Well, look, the top tip number 5 that I want to cover today is around something that I think is on everybody's mind at the moment. Working from home.
Tim, we do love it.
I think we all love it and we all hate it. I think it's an interesting topic. I don't know. What are your personal views, guys? Do you like working from home?
I don't personally like it. No, I find that I get distracted all the time. There's always food in the fridge that I keep reaching to. There's also TV playing in the background. You watch it, you think you'll take a half an hour break, and next thing you know, a couple of hours have gone, and then I'm having to catch up on my work. Personally, I'm not a big fan of working from home, Jazz. I find that when I go to work, I can focus more. I'm in that zone. So, yeah, that's my personal preference.
That's it.
But it's very popular at the moment that people want to work from home. And it is, you do save on time, commute to work and back. So there's certainly savings there. And each to their own on that one, I guess. There's no right or wrong, in my opinion.
Well, I mean, I personally need to work from home a few days a week because I tend to talk a lot when I'm around people. So my distraction is more in an office-based environment where I feel like getting up every kind of half an hour and having a chat. So I think a mixture is really my preference.
Yeah.
I wouldn't want to be at home all the time and not be around people, but a little bit of both is good. How about you guys?
I'm a bit like you, Jazz. I think it's a combination of it's great. We are mostly client facing anyway, and I love that interaction with the client. So I'm usually working from the office. I didn't mind during the COVID working from home. I think it was great. Just the amount of time it saves you in commute, you don't realize that until you go.
Yeah.
Yeah.
I think it was funny we talk about COVID. I think when it first happened, I was like, yeah, great. I get to work from home. I don't have to go into the office today. But then, look, trying to do it for a long period of time, I'm a type of person that loves dealing with people. I love interaction. I love talking to people. So when that piece was missing, I started to struggle a bit. But a mix between the two is actually really
I'm sort of sidetracking here, but, I was listening on ABC News that they're teaching people in Japan to smile again. Because they've been wearing masks all the time. So that was an interesting story. That's the thing about COVID. So, yeah.
It's changed the world.
It has. Maybe I think some of the social skill set was lost. I don't know.
And look, I think for me as well, I reached a point where I realized that I had looked at this same wall in the room I was sitting in for, 18 months or 2 years. And I actually picked up my desk and I changed it. I changed it to face the other way so that I had a different view. So I think a mixture is definitely best and we're very blessed. Yeah. But getting back to the tax deduction side of things, there's the ATO realised during that time that the method that they provided people with to claim tax deductions on the costs that you do incur when you work from home was potentially a little bit complex. So normally what you have to do is you have to keep an exact record of all of the costs that are involved with you working from home. The other thing that they realized was that there was some laws that prevent you from actually using your home as a place of work and a principal place of residence at the same time. So most of us probably know that the home you live in doesn't attract any capital gains tax when you sell it. But if you start to use that asset to work there, if you have a little shop at the front, maybe you're a hairdresser or otherwise, there's actually quite strict laws around that there not being the case, or you may be needing to reduce the amount of the home that is tax-free. So when you just live there, it's 100% tax-free from a capital gains tax perspective when you sell it. But if you do conduct business there on a regular basis, that percentage might drop to 80%.
Yeah.
So they removed that. First of all, they said, look, you kind of have to work from home at the moment, so we won't impact your capital gains tax position at the time you sell your home if you're making claims against that. The other thing as well that they did is they said that because it's pretty much the entire population, we will simplify the way that you can claim that tax deduction. It's kind of like when you claim your car use or part of your car use, you can simply claim a percentage of the costs that you have to run the car, or you can use a very easy method where you just claim certain amount of cents per kilometer traveled.
Yeah.
So there is 2 methods now that you can claim on working from home. The first one is called the fixed rate method, where you can simply claim the hours you've worked from home times a cent amount, and then you pop that number in your tax return.
Yeah.
And just like we said earlier with super, instead of then paying tax on, say, $100,000 worth of income, you might be able to save $2,000 or $3,000 off the top of that. So you don't have to pay the tax on that amount, and you can save a good amount of money, which then can go towards things like electricity bills, etc.
I was going to say that, Jazz. I don't know about you, but my electricity bill definitely went up working from home during COVID times. I knew my air conditioning was running above and beyond what it should be running.
That's definitely, it's being felt by everybody.
Yeah.
There is just one little note for the 2023 tax year. The ATO came out and said, look, if you're using that fixed term method, we may still require for you to prove the amount of time you've actually spent working at home. So they want to avoid anyone not doing the right thing and maybe not being 100% honest here and saying, yeah, I work from home all the time. So they are requiring people to now keep a log or some sort of a schedule, or maybe a copy of your employment contract that allows them to see proof of the amount of time you do spend at home. So if you work from home, say a day every week, that's about 8 hours of work. So you can then claim those 8 hours times the cent amount. Anyone else that wants to comment on that further? I mean, do you guys maybe claim that? Do you claim other things that you might have in your home, computers, phones, that kind of stuff?
So I leave it to my accountant to let me know what I can and can't claim, but I do know during COVID time they did allow, because people had to buy desks and chairs and monitors and all the computer accessories. So there was a certain amount that you could claim. Exact percentage, I don't know. I don't claim to be an accountant. So it is good to talk to the accountant on that one.
Yeah. I think there was a portion that the government allowed, which was a fixed amount, which I was aware of. So I do know that my accountant did do that for me. And I think it's a key consideration that if there was amounts above and beyond that, you'd have to then provide an actual proof of whether it be what percentage of time do you spend working from home in order to claim those deductions.
Perfect. And you can continue to do that now if you're working from home still. So make sure you do it if you can claim it. Get that money back into your pocket.
And keep the receipts.
Keep all your receipts, always. There's another topic that I often get asked about by clients. It goes back to the insurance space, but it's a little bit different. So this is not about the personal insurances we talked about earlier. This is about private health insurance. Dean, do you have private health insurance? Do you know how that works with tax?
Of course. So what happens is once you've reached over a certain income threshold, if you don't have any private health insurance, then the government will slug you with an extra bill called a Medicare levy. So it's a surcharge that they charge you for not having any private health cover. And look, the thing is, like, in this day and age, unfortunately, there's always going to be some form of medical situation, or you might have to always consult a doctor and see and so forth. Even if you're wanting to go and get a massage or anything like that, then private health insurance is definitely is very beneficial, and I've used it myself. I've got my fair share of massages and that, feeling a bit sore and stuff. So it's great.
Must have been sore from that tax bill, Dean.
Yes, that's right.
Especially optical and dental, because they're not covered by Medicare, so they generally really help with private health insurance, especially hospital waiting times. So private health insurance do come in very handy, and depending on your personal family income, government allows a certain rebate from tier 0 to tier 3, and depending on what means is government sort of subsidises a certain percentage of the private health insurance bill. So it's a good benefit to have.
Yeah, there is the two aspects to it, right? So if you go through to one of the insurance providers and get a quote, they'll ask you the detailed information, Ricky, about how much do you earn, how many people do you want on the cover. And then when they quote you your premium, they'll actually ask you whether you want to take the government rebate into account and whether you want the insurance company to claim that for you. So instead of having to pay, I don't know, $100, you can use that rebate on the spot and say pay $85. You do have to be mindful, though, that the ATO will backcheck all of that against your actual income at the end of the tax year. So don't underestimate your income when you're getting the quote, because you will have to pay it back when you do your tax return if you get it wrong. And then there is that other aspect of the Medicare levy surcharge. So if you think about it, you know, again, if we use the first example we talked about, if you earn $100,000, 1% of that is $1,000.
Yeah.
So you may be able to actually get that private hospital cover for that amount of money. It's definitely something worth looking into. And again, you can see the theme here. The government is rewarding us if we're looking after ourselves. So if we've got private health insurance, they'll give us that tax break. And instead of giving that money to the ATO, it goes directly to benefiting our family. I really like that aspect of controlling where some of the money that I've worked very hard to earn goes to, and controlling that impact that it has on my own family.
Yep.
So it's a really cool concept.
Also, point to note, Jazz, as well, after 30, if you don't have private health insurance, after 30 or 31, there's 2% levy that's charged on. So I would encourage people to do look at it, especially if you are over 30 and don't have private health insurance and you are thinking about it, there is a percentage added on.
That happened to my husband actually, because he lived overseas with me for a while and then he'd missed that. So he turned over the 30 at the time, and then he had to pay that for a period of time.
Yeah.
But it's also dropped off again. So he got rewarded for having the cover for, I think, a decade or something. And then that now has dropped off, that additional levy. So you definitely get rewarded for it if you keep the cover up.
To a certain period of time, yeah.
Especially for our listeners, if you have family coming over from overseas, I think it's very important that you call the insurance company straight up, because I think you get a month or two before that percentage sort of kicks on. So if you got someone over 30 coming over, then it's a good idea to call the insurance companies up front to avoid that.
Or any age group, really, for that matter.
Yeah.
Oh, well, amazing tip. I didn't know that. There is the 7th top tip that I want to talk about today. And I know my advisors are going to be really excited about this one. We live and breathe for people investing. Okay. So investing their money, making the most of their resources, really building up assets for their futures, being able to live their dream lives. So I'm expecting that this will be quite a fun discussion. What can you do when it comes to investments that might help you reduce your income tax, guys?
Just I'll start on that. Investment, anything related to income is tax deductible, generally speaking. So investment which allows you to put money away and generate income out of it, any expenses that you put towards it could be tax deductible. So it is quite good option available to encourage people to invest.
Give me a specific example of what you mean by that. So you're saying that if I invest some money and I have an expense while I invest that money, I can claim that as a tax deduction?
Well, generally you can, like if you set up an investment portfolio and you pay a fee to get advice, that can be potentially added towards the capital cost. You can't claim it straight away, but the capital cost of it can be added towards that. So when you sell or when you redeem the investment and get incurred CGT, so you can take that against the cost. Any ongoing fees that you're paying, that could also be potentially deductible.
I'm actually really interested in the fact that you didn't start talking about investment properties straight away, Ricky. Are you telling me that anything that I invest in might possibly be a tax deductible investment?
Well, it depends on depends on what you're doing. Like crypto, if, for example, government's really looking into it at the moment, so their rules are very unclear on that. So if you are thinking about investments, generally the rule is if it's about generating income and the expenses you've incurred for it, deductible. Like income protection premium, for example, because it's covering your income. So it's covering your income producing activity, so it's covered. So investment property, the expenses that you get to generate the rental is covered. So when you pay the real estate agent fees and all that, that's expense incurred, so that they can be deductible.
Just to add to that point as well, Ricky, a lot of the time people do borrow money from the bank, so they've got that interest expense when it comes to investment property, and they use which is called the gearing strategy, when you're using debt to actually acquire an asset. But even the same thing can happen on a parcel of investments and shares.
Exactly.
You can definitely borrow some money around that, and the interest expense associated with borrowing those funds to invest, and you can also claim those at a tax deduction as well. So.
Oh, look, Ray, that brings to mind one of the clients you helped that I don't think they would have probably been able to kick off their investments without that tax deductibility.
Absolutely, Jazz. So I think in this particular client situation, they wanted to create a form of an income which was completely separate to their wage and their salary that they're earning and the rental income that they're getting. They wanted to diversify how they were invested. So for them, a structured managed funds or a managed fund portfolio came in really handy because not only it allowed them to have another source of income, but managed funds served that purpose for that income. So in other words, the way how the investment funds work is similar to super is acts a bit like a rental property, if you like. So you get the capital growth. So if I had been invested in form of shares of the banks, if you like, so what I get is the capital growth. So if that share moved from $50 to $55, so I got that growth, but I then also got the dividends, you see. So that dividends act as a rental income. So is that form of diversification that they had. But any expense incurred to run that fund was then also generally was claimed that as a tax deduction.
Another aspect that I'd like to just explore a little bit more deeply here, and I know that this actually floats around on social media a lot, is this concept of, a family, they've bought their home, they've paid a bit of their mortgage down over a period of, say, 2, 3, 4, 5 years. They now know that they've got a bit of a buffer. They also know their property has probably gone up in value.
Yeah.
But they really want to purchase other investments from there on in.
Yeah.
Now, the loan that you have in your home and any interest you pay on that is not tax deductible. But there are a lot of people that are using these strategies to make part of the money that they owe in their home the startup for an investment. So they could go and borrow $50,000 against their home in a separate loan, and they can then tax deduct that because of what you said earlier around that being a direct cost of that investment. And you'd have to talk with your accountant about structuring something like that.
Yeah.
But I think that doing these kinds of things, starting up investments or being able to really make sure that instead of paying out taxes, we get those deductions. For us as advisors, those are often the keys to people that are financially more successful than others. So even though it takes a little bit of work and it's you need to be a little bit brave to take a new step, buy another property or set up a portfolio, it's definitely worth it.
Yeah.
Absolutely, yes. And it's all about growing the wealth. Like we said again, it's all more importantly that we grow because tax deduction is just a byproduct of it. And it's great that we get that back. But the whole idea is how we can grow it, how we can improve that. Because it's all about accumulating or taking small steps over time, which enables you to have a bigger portfolio at the end. Talking about just the structures, I was thinking about something else like the people set up trusts. And they hold assets under trust, they hold assets under companies. So this is quite important. There are different rules around it. We've talked about super, which has 15% tax bracket, whereas a company has about 25%, around 25 to 30% tax bracket. So it is important how people hold their structures, and having that proper structure in place is quite critical. But the main idea, again, remains growing the wealth.
Yeah.
That makes total sense. Look, we've covered a lot of ground here, but there is one other really cool tax benefit that we cannot miss and we have to talk about. We're very blessed in Australia actually to have this concept. And there's plenty of times when, especially there's change of governments and elections, franking credits are talked about.
With this, Jazz.
Now, can someone please explain what franking credits are to get us started with this last topic?
Well, I can go. Franking credit, what it necessarily means is in Australia, so companies, when they earn an income, they pay company tax, and they also pass on the earnings back to their shareholders in the form of dividend. That's why we invest in companies in order to get another source of income. As the companies are more successful, we get a dividend back from them. So the whole idea of franking credit is if the company has already paid the tax, when the net income is then given down to the shareholders, then the shareholders, because it's also an income for the shareholder, then shareholder would also need to pay tax on it. So it's just to avoid that double taxation, because if I've got $100 from a company A in form of dividend, which has already been taxed at a company level, then if I'm also having to pay a tax on that $100, then it's double taxation. So in order to avoid that, what government allows is a franking credit, where you can offset that tax paid by the company, and then we get that franking credit back, or we pay a sort of reduced tax on it.
And why is the franking credit itself one of the most exciting deductions? I can tell you, it's because you actually get the money back.
Correct.
So I will fondly remember this when I was working in one of the branches in the south of Sydney as a bank financial planner, decade ago. I would have around 5 or 10 senior citizens coming around tax time, and they would be getting ready to go and see their accountant and actually fill out a tax return just because they were shareholders of companies that were paying dividends at that time. And the Australian government's really cool here. They don't hold on to that money, as you've just explained. So those people that weren't really filling out tax returns for income from working or otherwise, they went and got their taxes done because they'd get a little check from the ATO that would pay them back that company tax portion of the taxes. So it makes me really fondly remember those times back in the branches. But that's why the sort of franking credit concept is so exciting, because there's really no other tax you're going to get back unless you've already paid the tax.
Yeah.
It's different with the franking credits, and that's why they're so cool.
And it was a great thing for the retirees because they got that extra money back and got them so excited, saying that, they've received X amount of dollars in dividends.
Well, look, thanks so much for the contributions. To all of our listeners and viewers, we hope that you've taken away at least 1 or 2 tips out of the 8 we've gone through today. Do remember to speak with your accountant and financial advisor about all the strategies that you've heard today and see whether they actually suit your needs. And we can't wait to see you again on the next episode.
Thank you.